Hi guys, it's MJ. Speaking with you from Zurich, where I met some of you yesterday, my investors, and actually I got asked a question by Conrad here, one of the investors on eToro, and I got the same question yesterday from a Swiss client, and the question is how you should think about the investment with me, how you should plan your investment strategy really, which many of you don't have, but you should have some sort of investment strategy, and whether you should use the money to, I don't know, for retirement, for holiday, as a stable income and savings. So I will talk to you a little bit about that. So first, you should have investment strategy. So when I work for my wealth management clients, I always sit with them and we talk about their wealth in general. So we talk about, how many houses they have, how many cars they have, what's their level of debt, how much liquidity do they need, do they go to the stock market, do they have art collection, which is less liquid, maybe they collect old cars or wine or whiskey or whatever. So you always should have an investment strategy. For many of us retail investors, it's much simpler. So you basically think about how much money you make and how much money you save and what's your current level of savings or debt. I spoke about reducing your debt immediately at one of the interviews I gave in French in Portugal with Andrea Roberti. So if you have any debt on your credit cards or anything else with a high interest rate to pay, you need to do it. You need to repay it immediately, and you should start saving as much as possible, and then we can do dollar cost average investments and use the compound interest to build your wealth. So in terms of investment strategy, you should at least know, okay, I'm saving maybe, 500 euros a month, and I want to invest 200 or 250 of it, or whatever the number may be. And this is the least that you should have. Now, Comarco asked me about the stable income, about retirement, and about holiday, and how he should think about that. And a similar question came from my investor here in Switzerland. So when you register for eToro asks you about that. It's a question that every broker will ask you, because that's kind of your reason for investing. And for all of you, it will be different. For me, as you know, it's part of my job, so I do it mainly to, I do it because it's my job. So I'm not really obsessed with the figure, whether it's a dollar figure or whether it's a percentage figure. I invest as well as I can, and I test myself with the market. For some of you, maybe a specific goal. Let's say you put 10,000 and you want to make 5,000 profit, and you want to use this 5,000 for a nice holiday, or you want to maybe take 2,500 for a holiday and keep 2,500 reinvesting. So if you want to do compound interest, you need to reinvest the income, the capital gain that you have with future investment. So holiday is a good goal. Having a house is a good goal. A retirement, obviously, depending on how old you are, it's a very long-term horizon. But I think it's definitely better, to do it for the retirement this way on eToro. eToro doesn't charge you any fees. I was interviewed by a very high-level money manager in New York on Monday, which can bring some interesting results for us here on eToro as well. And we talk about that you don't have to pay 220. 220 is a standard fee that you pay to your hedge fund managers. 2% is a management fee, so every year you pay 2% to a hedge fund, and you have to pay 20% above the benchmark performance, so the watermark. So here in eToro you pay zero, which is absolutely phenomenal. So you have no cost, and also we have no cost for buying European equity and equities as underlying assets. So that's great. So let's say you can have a specific goal. Let's say make 5,000, 50,000. But I think the best goal, if you can afford it long term and you have a long-term horizon, you should think about it as a regular investment. So you will get a saving account on a bank that will pay you probably between minus 0.5 to 0.5% at the moment with the current interest rates. So with me, as we talk about 50% in the 6 to 24 months and probably 20% a year, obviously it can go down as well. So it's not as safe as a saving loan, but if, inflation is beating your savings, so you're actually making minus, so you're losing money. So if you think about like 20-year investment with me for your retirement, I would most likely outperform the funds, because the funds cannot short. For instance, so when we have coronavirus and I'm now shorting Americas, they cannot do it because they cannot short, and overall their performance is pretty bad. Unless you get really good tax advantages, you most likely be better off. So again, you have your investment strategy. It can be mixed. You can put, let's say, 80% with me and treat it as a long-term investment, and you can put 20%, on a very risky. Let's say you want to buy Aston Martin or whatever, Wirecard or Hertz, and you can play with it. And actually, I would say if many of you joined and asked me to be your mentor or help you teach you investments, a good strategy would be, let's say, put 80% or 90% with me, and then put 20 or 10% on your own account and actually do the trade, lose the money, burn yourself on a leverage, but use those lessons so you can understand the market more and grow. Virtual accounts don't really work. There's no money at stake. There's no emotions when you don't lose any money, but you need to keep calm. You're losing money today on paper, virtual money, but we're actually buying, just bought SES at a beautiful level, and hopefully RTL will get in and maybe some Investec as well. So yeah, have an investment strategy, and your goal will depend. I think the best goal is to have a 3, 5, 10, 15-year horizon and just add more funds and look where you'll get in 15 years. You'll be quite well off. So that would be my recommendation. But if you want to calculate this 50%, and then you can say, I want to do it I want to put it up for a house, or I want to have a nice holiday. I have a client in Luxembourg who wants to go on holiday for the gains. So always speaking free. So I talked about investment strategy and the stable income. Now I want to talk about, I will share a little bit about what I learned in finance when I worked for Leaper. Leaper is a leader in the fund market together with Morningstar. Leaper is a part of Thomson Reuters, now Refinitiv. And the strategies we had for the funds, they're basically grouped. Leaper gave like Oscars for funds, so rewarded the best funds in the world. And we had three main categories really. One was total return, another one in risk-adjusted return, and the third one was capital preservation. So these are really three different strategies. eToro asks the popular investor to describe their investment strategy in the bio, but they don't yet classify people on a type of investment. So let's talk about those three. So total return or absolute return is focused on the gains only. So you just care about the maximum amount of return that you can generate. So we are regulated kind of to keep the risk at a reasonable level as popular investors. But non-popular investors can go up to 10. They can use leverage. So people who use total return, they would buy things like Hertz or something just to try to maximize. And that return, it's usually quite risky, but you can get during period of COVID, you can get some crazy numbers, which is good. And the problem with that strategy is that, let's say you make 100% this year, so you go from 10,000 to 20,000. What happens if next year you go 50% down? You're back to 10,000, so you're zero in 2 years. So that's the little bit of a problem, is even if you have many good years, and then you lose 30-50% in a year, it kind of wipes you out. So that's a bit of a problem with total return. But if you're very young, for instance, so we always recommend it. Leaper doesn't recommend funds; it just groups them and does analytics on them. But these funds are more towards a younger population, because let's say you're 80 to 35. Let's say you have maybe 40, 50 year horizon for your investments, so you can take the risk. More risk for a higher reward long term. So if you find the next Apple, you try to maybe find something like this, you buy 10 smaller stocks, maybe in 20 years, one of them will become really big. And even though you take a lot of risk now buying smaller stock, it could be worth it, okay? So that's total return. The second one is risk-adjusted return. So that's more or less where I sit between the second and the third. So risk-adjusted return is kind of taking an absolute return. We all want to have as high a number as possible, obviously. Like, 20 is better than 10. But a risk-adjusted return takes risk into consideration. I recorded a video on risk management, so I'm not going to do that. We talk about standard deviation, value at risk, maximum drawdown, Sharpe ratios, all the kind of things, diversification, uncorrelated returns. So watch the video again if you want to get familiar with it. But basically, it's important to just make sure that you are taking care about your portfolio risk, and therefore you have risk-adjusted return. So you think about that. You may have a trader that makes, let's say, 50% this year, loses 30% next year, then he makes 70%, then he loses 80%. So very volatile, very unpredictable. And then you have another guy who maybe makes 10% a year, and he makes between -5 and let's say 20. That's kind of where I consider myself to be sitting. Then you have much more predictable returns, and over time you probably be better off, and you can sleep better. So that's kind of a risk-adjusted return. I'm not saying one is better than the other; they're just different strategies. And the third is capital preservation. So I used to say, if you're near the retirement, you see the light at the end of the tunnel. Then what you want to do is to preserve your capital, right? You've saved throughout your time, for your work, your career, and now you have some savings, and you're nearly retired or retired, and you don't want to lose the capital. So the most important rule of Warren Buffett: never lose money. So you want to just preserve it, and you may be happy actually having a bond in your portfolio generating you 2-3%, and that's enough for you because it's still better than the bank, but it generates the return without any risk or very, very small risk. So three different strategies there. I told you, I'm at the really risk-adjusted return, not the total return. That kind of would be other brokerage where I take more risk. And then I will go not really to capital preservation because it's not interesting for me to generate 2%. There are some traders here who make very small numbers every month, and it's great. But like during COVID, okay, we're 10% up. We were 25, so obviously it's more volatile. But 10% is still much better than 1 or 2 during such asymmetric mispricing that's happening. So I don't want to go there because I think it's definitely not enough for me. I'm targeting 20%. But you may want to, I don't know, you're saving for your MBA and you just want to preserve the capital. You may be interested in strategies like this. So I think that's the 3 points I wanted to cover. To sum up, you can consider my investment strategy as between risk-adjusted return and will go towards capital preservation. Again, 6 to 24 month horizon is great. I'm targeting 50% there, then probably between -5 and 20% a year. And you can think about it as a safe investment. So you may want to put 80% of your capital there. Best to put it regularly so you get the low cost average and then the compound interest. And if you want to do something much more risky, maybe buy some of the riskier stocks that I have and I write about them frequently. Or if you want to learn trading, then trade on your own with this 20%, not with 100%, so you don't lose everything. So my investor said yesterday, "Oh, I'm glad because you're in the green, but when I'm investing in myself, I've lost quite a bit of money, but I'm happy that at least the lion's share of the portfolio is in the green." So that's it. Give me your feedback. Tell me about other portfolios that other videos that you want me to record. And I'm sending my best regards from Zurich, and I'm back to trading because it's a very interesting day today. Thanks, guys. Take care.